This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to carry on now with this chapter on Macaulay duration and valuation of debt. And when I came to the end of the previous lecture, for these two bonds we've been considering, we looked at how a change in the investor's required return, in the yield required, how it would affect the market value. And I said that the reason bond 2 was a lot more sensitive to changes, market value would be a lot more affected, this 26% instead of 17 for those two rates. I said that that was primarily due to how long it was taking, effectively, for them to get their yield. And the Macaulay duration that's referred to on the next page, duration is time, it effectively looks at the average time it takes, the average number of years, effectively, to get half the money back. Now, I'm not going to prove that, but it is an average time that we calculate. And I've written the rules down. Calculate the present value of the cash flows, add them up, multiply the present value of the cash flow for each time period and add them up, divide the results from B with the results from A. Well, rather than keep reading that, let me show you with example 4 how we actually calculate it, and you'll see how easy it actually is. It says a company has 8% bonds in issue, redeemable in 5 years' time at a premium of 10%. The current market value is 98.63. Now, in fact, that's exactly the same bond that was in bond 1. If you look back to example 1, sorry making you go backwards and forwards, but bond 1 was 8% bonds in issue, redeemed in 5 years' time at a premium of 10%. It said the investor's required return is 10%, and we worked out the market value, and we got 98.63. And so, since the present value of those receipts at 10% was 98.63, well, we already know the answer to A. The gross redemption yield was 10%. So it's a bit of a silly question, that. However, more importantly for what we're doing, it then asks for the Macaulay duration. And what we do is this. We set up the future receipts just as we did before. So 5 years. On $100 nominal, there's $8 a year interest. And then in 5 years' time, there's the redemption, 110. And first of all, we discount each of the flows at the gross redemption yield, the yield to investors, which hit 10%. Now, I know we did it up above, but I don't do winding up and down the screen. But again, if we discount at their yield of 10%, the current yield, the factors are 0.909. Wrong tables. Oh, where are they? 0.909. 2 years at 10%, 0.826, 0.751, 0.683, and 0.621. The present values, therefore, I know, again, we've done it before, but still, it's 7.27, 6.61, 6.01, 5.46, 73.28. We add them up to get the total present value. I'll leave a space because some more working somewhere to come back to. but the total present value 7.27, 6.61, 6.01, 5.46, 73.28, 98.73. What's that? Oh. I've added up wrong, or I've got a figure wrong. 7.27, 6.61, 6.01, 5.46, 73.28. 98.63. And of course we knew that's the market value. So that was a straight repeat. But that's part A. Calculate the present value of cash flows and add them up. A, in the rules above. What we then do looks a bit strange. I'll try and explain after, but it's very easy arithmetic. We then multiply each of the present values by the time period, and we add them up. Now what I mean is, the present values, at time 1 was 7.27. We multiply by 1, it's time 1. The second one at time 2, we multiply by 2, time 2. Next one by time 3, time 4, time 5. We multiply by the time period and we'll add them up. And so what do I get? 7.27 times 1 is 7.27. 6.61 times 2 is 13.22. 6.01 times 3 is 18.03. And 5.46 times 4 is 21.84. And finally, 73.28 times 5 is 366.4. So, as I say, I've yet to explain why, but arithmetically, I hope you're clear about the rule. You've got the present values at the current gross redemption yield. You multiply by the time period. We add those up. And the total now, 7.27, 13.22, 18.03, 21.84, 366.4. I get 426.76. So just let's finish the pure arithmetic. That's part B of the list I gave above. Part A, the present value of the cash flows. Part B, the present value of each cash flow multiplied by the time period added up is 426.76. And then to get what we call the Macaulay duration, we divide the answer in B by the answer in A. 426.76 divided by 98.63, which comes to 4.33 years. Now, we'll talk about the significance in a moment, but what we've effectively done, two things in one really, we've taken a weighted average of the time over which we're getting the money back. You see, the total is 98.63, the present value. The first year is giving us 7 out of 98.63, that proportion. In 2 years, we're getting 6 out of 98.63, that proportion, and so on. And so we've used effectively those proportions to get the average number of years. We've used those proportions multiplied by each year to get an average. But instead of saying, oh, it's 7.27 divided by that times 1, it's 6.61 divided by 98.63 times 2, and so on. It's quicker to do what we did, multiply them all by a number of years, and divide by the total NPV. So that is the average time, effectively it's the time it takes to, in a sense, get back half our money. And the shorter that period is, the better. The shorter it is, the less sensitive we are to these changes that are going to be in the market value. And to, in a sense, prove what I'm saying, you have a go. I'll pause the lecture and then come back and check me. But you have a go at example 5, calculating the modified duration for the bond in example 2. I'll start you off. For the bond in example 2, if you look back at it, we'd worked out the redemption yield. If you look back, I'm not going to wind the screen back, but since we knew the current market value and we knew the receipts, we worked out the internal rate of return. We got 10%, and so the redemption yield, again, 10%. And for the Macaulay duration, we do exactly the same as we did in the previous example. So sorry, I'm doing example 6, but we're using the figures from example 2. And so we do exactly the same. We'll set up the receipts, and here there are 10 years. There's $8 a year interest, and then the redemption. And to get the Macaulay duration, we'll discount at the redemption yield of 10%, get the present values. We'll add them up, and that'll be part A, the total of the present values. But we'll then do the part B. We'll multiply each of them by the number of years and add them up, and then divide one by the other. Because of that second step, I hope you've seen why I didn't use annuities before. You see, if it was only the present value we needed, we could use annuities. But we need all the individual present values to do this multiplying by a number of years. Well, I don't want to just plod through talking through every figure, so I do suggest you have a go. Speed on your calculator, it's not hard. That you pause the lecture. When you've done it, look back, and I'll do it as fast as I can. I'm not going to talk through every figure. All right, well, I'm going to assume you paused the lecture, and so you've done this yourself, and you're about to check with me. So first of all, discount all the flows at the redemption yield 10%. The factors. The present values. Keep to 2 decimal places. There are the present values. We now add them up. I'll leave a space because you know there's this next bit of workings coming. But if I add them up, the answer to A in my list of steps, the total of those 7.27, 6.58, 6.01, 5.46, 4.97, 4.51, 4.10, 3.74, 3.39, 45.55. The total 91.58, which should be the market value. I may have made a tiny mistake, but it's so close to 91.61, I'm not going to waste time. However, for part B, we multiply each by the number of years. So that's 1 year, 2 year, 3 year, 4, 5, 6, 7, 8, 9, 10. And as I say, if I've made a tiny arithmetic mistake, I'm not worried. Look at the answer in the back anyway. But multiplying up, 1 times that, 7.27, 2 times 6.58, 13.16, 3 times that, 18.03, 4 times 5.46, 21.84, 5 times 4.97, 24.85, 6 times 4.51, 27.06, 7 times 4.1, 28.7, 8 times 3.74, 29.92, 9 times 3.39, 30.51, and finally 10 times 45.55 is 455.5. Add them up, ooh, 656.84. And the final step, divide B by A. So the Macaulay duration uh, 656.84 divided by 91.58 gives me 7.17 years. Now, can I repeat, if you're checking me, because the actual market value, that should have come to 91.61, I think it was. Yeah, 91. So maybe, I don't know, maybe I did make a tiny mistake somewhere, but I'm not going to go all the way back through. The important thing is that you're clear what's happening, how we're doing the figures. So if I'm slightly wrong, too bad. And too bad for the exam, I wouldn't really care for the sake of half a mark. But more importantly, is what this means. Again, that's effectively, for this bond, the time it's taking to get half my money back. That's really what it is. It's a weighted average. And you see, if you compare those two bonds, bond number 1, its duration was 4.33 years. Bond 2 was 7.17 years. And the longer it's taking to get half your money back, which is what this Macaulay duration is, the longer it's taking, the more you're at risk due to changes in required returns. We already knew that, we'd illustrated. But we know what current market values are, we know what current required returns are. If we work out the Macaulay duration, That gives us an indication of which is more risky, which is more sensitive. The one with the longer duration, so bond 2, is more sensitive. And we can go one step further, which is unbelievably easy. Given that we're talking about the sensitivity, how much the market value is going to be affected by changes in required return, we can calculate what we call the modified duration, which on its own is so easy it's untrue. I've given you the rule just above example 6, but the modified duration, we take our Macaulay duration, so that wasn't hard to calculate, it's just all about those workings. We divide by 1 plus the investor's required return, the gross redemption yield. And so this really does only take a second, and then the final bit of interpreting. For bond number 1, the Macaulay duration was 4.33 years. For the modified duration, 1 plus the gross redemption yield. Well, if you remember, I know it might mean looking back, but in both of these, the current gross redemption yield was 10%. So 1 plus 10%, 1.10. And it gives us $3.94. And arithmetically, for bond number 2, 7.17 divided by the current gross redemption yield. Appreciate, if you're looking at two different bonds, they won't necessarily have the same gross redemption yield as they did here. But here, in both cases, it is 10%. You know, if bond 2, if the gross redemption yield was 12%, you divide by 1.12. But as a result, the modified duration is 6.52. And what that effectively means, that as interest rates change in the future, as interest rates go up by 1% or down by 1% and so on, we already know, we've illustrated, the market value will change. Well, we're effectively saying the change in the market value will be, in the case of example 1, it'll be 3.94 times the change in the interest rates. Now that's stated over the following page, and you don't need those symbols. But basically, the change in the market value will be equal to the modified duration times the change in the interest rates, yields. So a direct measure of sensitivity. They're clearly number 2. As yields change, the market value will change by a lot more, 6.52 times, by a lot more than the market values of number 1 would change. So again, if you were comparing investments, but as I say, you won't be asked to choose in the exam. You just expect to be illustrate how we calculate the Macaulay duration, modified duration, and the basic interpretation of them. But it does mean if you were choosing between them, you, in real life, you would obviously consider the yield. Higher yield is better than lower yield, even though here they're the same. But you'd also take into account the sensitivity. 2 is more risky than 1 because you're much more affected. Your capital value is much more affected by changes in interest rates. You will see a little graph on the next page, which you don't need to repeat. But effectively what we've done is assuming a linear relationship. It's assuming that as yields go up, market value will go down and vice versa. But it is effectively assuming that it goes down linearly. Higher yield, lower market value. Well, in fact, it isn't linear. The relationship would be a curve. And so effectively, what we've done is only approximate and strictly only works over sort of small changes. All right, now all of that did take a while, I appreciate. I'm sorry, but I didn't invent it. But that was all relating to bonds, and it has been asked in that sort of form. However, as I said at the beginning, since we've covered how to calculate Macaulay duration, multiplied by a number of years and so on, as I'll show you, we can use exactly the same arithmetic to look at the riskiness of a project. We call it the project duration. So, one more lecture, which will be a very short one, but applying the same arithmetic to a project.